My investing career took off when I first encountered John Templeton. It was 1987, and he was this billionaire money manager, and I was just a few years out of college, writing an investment newsletter. I asked him, by fax machine no less, for an interview. That fax changed my life. For those of you who don't know Sir John Templeton, he was among the absolute greats in investing. He died in 2008 at the age of 95, an amazing man. I'd even say a mentor and friend. I met him in the Bahamas shortly after the market crash of 1987. While that crash just looks like a tiny blip on the chart now, it was a huge deal then. It's really a funny story how we met. His office had agreed to a telephone interview for my startup newsletter, but he missed the appointment. By way of apology, they let me fax him a few questions, one of which was, where is the stock market headed next? Now for context, this market had risen 5 straight years, starting around 770 on the Dow in 1982 in Reagan's first term, and rising almost nonstop to 2,500 at the time of our interview. It peaked 2 weeks later as high as 2,700. I was curious, as were my readers, about what Templeton believed would happen next. He answered with his trademark style of wisdom. Got it right here in the newsletter. It says, let me quote, "I can promise that sometime there's going to be a bear market. So you have to prepare yourself mentally to live through a bear market without worry or misfortune. Now, how great a bear market? It is not unusual to have a correction that carries the stock market down by 1/3 from the previous peak. If we're talking about the familiar Dow Jones Industrial Average, that would mean that the average would go down from about 2,500 to about 1,700. So it's perfectly possible that there could be a drop of 800 points or more on the DJIA. When? He indicated that could happen as soon as October of that year. Now take a look at what actually happened. Here we have got the market where it hit 2,500 when I interviewed him, went all the way up to 2,700, and then dropped to 1,700 2 months later, October, just like he'd suggested. It's incredible to imagine that as a 25-year-old newsletter writer, I was interviewing John Templeton at the most critical point in the market. Now here's what's really weird. That very month, August 1987, as the stock market was peaking, I also featured Warren Buffett in the very same newsletter. We had an investment strategy section, and I reviewed the book, The Midas Touch, extracting practical lessons from Warren Buffett. In virtually any survey, you'll see the names Buffett and Templeton included in the list of history's greatest investors. Templeton passed away at age 95 in 2008. Warren Buffett just announced his retirement at age 94 this year. According to Wikipedia, Sir John averaged gains over 15% per year for 38 years with his Templeton Growth Fund. And that fund started in 1954 and did not include his incredible gains starting from 1939 to 1954. Money Magazine named him arguably the greatest global stock picker of the century in 1999. Warren Buffett has reportedly averaged 19.9% from 1965 to the end of last year. While you can't compare apples to oranges because they manage money over different time periods, they obviously both enjoyed spectacular results over a very long period. There's a lot we can learn from them. Now, I was honored to be handpicked by Sir John to help start from scratch, build, and later run what became a $2.4 billion division of Franklin Templeton when I retired. But it's been a quarter century since I left Templeton and 17 years since he passed. His wisdom still provides guidance, however. Both Templeton and Buffett use a value approach to invest similar to Ben Graham, who came before and authored the book The Intelligent Investor. Both Templeton and Buffett beat the market by wide margins. What they differed on actually was very little. In fact, when they were both interviewed by Adam Smith on television, Sir John explained the primary differences in their approach. Let's roll a clip.
Academicians have a theory that no one can beat the market consistently, that the markets are efficient, that all the news is already in the price. And yet there are a handful of great investors who have single-handedly disproved that theory by consistently beating the market over a period of many years, and you're one of them. How would you distinguish yourself, say, from Philip Fisher or Warren Buffett?
Probably in the fact that I look worldwide more than the others do and search in a wider variety of areas. probably because I'm willing to make estimates of earning power further into the future than others are, and certainly because I rely on prayer in everything we do. We open all of our directors' meetings with prayer. We pray about every decision we make, and in the long run, that means you will still make hundreds of mistakes, but less mistakes than otherwise.
Did they ask you whether you prayed for stocks to go up?
Well, yes. That would not work, of course. If we prayed for something we bought to go up, it would be ridiculous. So instead of that, I think we would try to follow Solomon, who prayed for wisdom.
Templeton has offered a prize for religious work and thinking, but there are others with a more secular approach who have also been very successful. Let's take Warren Buffett of Omaha, Nebraska. If you had put $10,000 in 1965 into his company, Berkshire Hathaway, you would have $1 million today.
So those were the three differences. Templeton would look more worldwide, Buffett more on the U.S. Templeton looked a little further out in the future, and he focused on prayer. But both looked for great long-term businesses that they could buy as good values. I share all of this and how I met John Templeton as a setup for our guest today. I was sent a book by a friend, Buffett's Two-Step Stock Market Strategy, written in 2020 by a young man named Daniel Jiwani. He studied Buffett like I studied Templeton. The book is practical, sensible, and easy to read. It felt a little deja vu-ish. I wanted to meet Daniel and learn more. Then I found out that he follows the Economic War Room, and he said I was the best podcast host in the world, so that caught my attention. I learned that Daniel had written a new book titled Take Stock in This, an easy way to decide what stocks to buy and when to buy it. Let me quote from the introduction. In the introduction, he talks about take stock in this strategy. If someone knocked on your door today and asked, would you want to buy my family business from me, how would you approach that decision? Well, first, you'd want to make sure it was a good business. Then you might want to know if they were selling the business to you at a fair price. You would also probably care about the risk-reward trade-off of buying the business. Sounds logical, right? It absolutely sounds logical. So, you want to learn more? I've invited the author, Daniel Jiwani, to the Economic War Room. I want him to discuss his investment journey. I want him to explain what he's learned and what you need to know. I've only met him through his books. You and I are meeting him right now together at the same time. This is a young man. I think he's 23 years old, and he has written 2 best-selling books, and he studied how to make money in the stock market. Let's learn more right after this break. You absolutely don't want to miss the chance to meet Daniel Jiwani. In uncertain times, finding stability in the economy can feel challenging. But what if you could navigate economic volatility while honoring your biblical values? At Timothy Plan, they believe this balance is possible. Timothy Plan filters its volatility-weighted ETFs and family of mutual funds through a biblical pro-life and pro-family lens, so you can see competitive returns and moral responsibility, helping you to weather the economic storms. With Timothy Plan, align your investments with your values while adapting to our ever-changing culture. Since 1994, Timothy Plan has been recognized leader in biblically responsible investing. Timothy Plan, your bridge between faith, finances, and the future. Visit timothyplan.com or call 1-800-TIM-PLAN or 1-800-846-7526. Investing includes risk, including possible loss of principal. Before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus available at timothyplan.com.
Oh, hi, I'm Kevin Freeman, and I'm here to tell you about coffee. Well, not really, but I'm going to use coffee to illustrate my point. Here we have several different coffees, each with its own unique characteristics. First, we have instant coffee. This coffee pretends to be coffee, but it's not really coffee at all. It's a fraud. Plus, it tastes terrible. I'm out. Next, we have woke coffee. Their coffee actually tastes pretty good, until you find out that when you drink it, you have to admit that you've oppressed other coffees in the past. Insanity. I'm out. Next, we have Big Tech Coffee. Now, these guys used to encourage folks to share with others what they thought about their coffee. But now, if you say you don't like Big Tech Coffee, they'll take away your coffee pot. I'm out. This brings us to Patriot Mobile Coffee, right? This is one big cup of truth and freedom. There's no fraud here. Patriot Mobile is America's real Christian conservative wireless provider. Patriot Mobile gives back millions of dollars every year to organizations that are on the front lines fighting for our freedoms. Patriot Mobile offers the best nationwide 4G and 5G coverage on the same networks as the other major carriers. So you'll get the same great coverage along with 100% US-based customer support while knowing you are supporting a company that shares your conservative values. Switch to Patriot Mobile today by visiting patriotmobile.com or call 972-PATRIOT.
Before the break, I shared a little of my personal story. In my 20s, I was mentored by the great Sir John Templeton and adopted his investing style. I also shared about featuring a man I've never met, but who is included in the list of greatest investors of all time, along with Templeton and Peter Lynch and Phil Fisher and a few others. In fact, I featured a book about Warren Buffett in my newsletter some 38 years ago at the very same time I met John Templeton. Then I shared that much more recently, another 20-something was studying Warren Buffett like I had done with Templeton decades before. And he's been doing very well and has written a few books on his own. I'm talking about Daniel Jiwani, the author of Buffett's Two-Step Stock Market Strategy. In 2020, he published it, and most recently he's written Take Stock in This, that was published last year. He's our guest today. Daniel, welcome to the Economic War Room.
Thank you, Kevin Freeman, for having me.
How is it that you got started in investing? Where did you pick up that you were 16 or something? Tell us your story.
Yeah, sure. So when I was growing up, I was like everyone else. The only thing that was on my mind was basically getting rich. And with my father having CNBC with Becky Quick on every single morning, the first thing that came into my mind was stock picking as the way to get rich. The only issue that I had was that I wasn't a very good stock picker when I started. My grandfather had lent me a couple $1,000s. I invested it all in General Electric. Next thing you know, I lost 50 to 70% of my money within a couple of weeks. So I wasn't a good stock picker when I initially started. And I knew that I needed to get better. The way I thought I could get better is by taking Warren Buffett as my investment mentor. So I studied everything he's ever said, watched every YouTube video he's ever been in. And by doing that, I became pretty good at the stock market. I invested in Apple at like $38, is now over 200. I outperformed the S&P 500 by 150% with my investment in Meta. I outperformed the S&P by 100% with my investment in the Cheesecake Factory. So I got pretty good by studying Warren Buffett's investment philosophy and published everything that I learned in my book called Buffett's Two-Step Stock Market Strategy.
Yeah, no, it's a great book. So what intrigued you about Warren Buffett? Was it just his performance? Or was it that you'd seen the interviews with Becky Quick and you realized this guy's really smart? Or why were you so attracted to him?
I think that Warren Buffett is a little bit different than everyone else. Compared to most hedge fund managers, most CIOs, chief investment officers out there, he has a true business owner mindset. He looks at every single stock as a real piece of a business. The example I like to give is that when he buys a business, he takes a 20, 30-year mindset toward the business, not a 6 to 12-month mindset like most other investors. So he's a very long-term investor, which I think is different than compared to most investors out there.
Yeah, no, it's a lot like John Templeton in that respect. You share a two-step strategy. I know you got to read the book to get the full meaning of it, but what are the two steps, just at the high level?
Yeah, it's to buy a wonderful business at a wonderful price. In terms of buying a wonderful business, you want to look for a simple business, one that has predictable cash flows, one that's dominant, as Bill Ackman says, who's another famous investor. And in terms of buying the business at the right price, the key here is to focus on cash flow. Just like when you buy a real estate property, you look at the cost of buying the property and how much rental income the property will generate. You want to look at the price of buying the stock relative to how much cash flow the stock will earn in the future.
Yeah, no, those are principles. In fact, you've got a quote here from Warren Buffett in your book. It says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." So that really distinguishes him from many other investors who I'm just looking for the cheapest thing I can. It might be a terrible company. Or the other distinction is, are you buying a stock or are you buying a business? It sounds like you take the approach that you're actually buying a piece of a business.
Yeah, no, that's exactly right. I mean, if you take a look at real, not stock pickers, but business owners out there, Mark Zuckerberg of Meta, Jeff Bezos of Amazon, you notice that they're business owners. When they started their business, they came in with the mindset that I'm going to own this business for the rest of my life. Warren Buffett takes that same approach in the stock market. He comes in with the approach is when I'm buying Apple, when I'm buying Meta, I'm going to own this business for the rest of my life, just as if I was a business owner in it.
That takes you completely away from this quarter to quarter. Did they hit their earnings targets this year or this quarter? What's the outlook next quarter? You're taking a very long-term approach when you say for the rest of my life. I mean, for you, that's a very long period. It's kind of hard to find those companies unless you're taking that business-like approach. How's it been going?
It's been going well. So far my approach has been going well. When people say like, oh, that's a real kind of like you mentioned, oh, that investing for a 10 or 20-year period is a very long time. It's a very long outlook. What I like to say to that is that most people are willing to go to college for 4 years, but they're not willing to hold a stock for 4 years. Or better yet, most people are willing to take on a mortgage, take on a liability for 30 years. They're willing to pay a bank back debt for 30 years, but they're not willing to hold an asset like a stock for 30 years. To me, that doesn't make a lot of sense. I would much rather own a stock for 30 years than be paying a bank a mortgage for 30 years.
Oh, that absolutely. But emotions play into it. And you've got a whole section in here on the role of emotions. Can you describe, most emotions are driven either by fear or greed, but they cause people to jump very quickly. What's the role of emotions and how do you overcome those as an investor?
I think, well, emotions are not good. They're not a good thing when investing. Investing is a pure mathematical game. It's about buying a company at a discounted valuation. It's about buying a quality company. It's very methodical the way you approach investing. The way I like to cope with emotions is by really focusing on the customer and ignoring all the other noise in the market. At the end of the day, the most important thing when investing is the customer. The company that makes the best products for the customer over the long term is going to perform the best. So I like to ignore all the noise, the tariffs. I like to ignore the economic news. I like to ignore a lot of the quarter by quarter earnings and just focus on the customer. That helps me keep a very objective lens and not let all the emotions with the noise in the market cloud my judgment.
Well, contrast that with a typical investor. What kind of emotions do you think the people who are making mistakes basing decisions on their emotions? What are they feeling? What are they doing? And how is what you're doing different?
Most investors have too much panic in them. They're too worried about what's going on in the markets. For example, when inflation was really high, the number one question I was getting is, what should I do with my portfolio now that inflation is high? Or same thing with tariffs. When tariffs were real, and they're still in the news. When they were in the news and they are still in the news, people are asking me, what should I do given all the tariffs? For me personally, I just ignore it. I don't care about it. So people have too much worry, too much panic about what's going on in the markets.
All right, we're going to need to take a break. When we come back, I want to dive into your new book, which is titled Take Stock in This. You've got some really practical things people can do step by step in order to be successful as investors.
I'm Kevin Sorbo. When you spend money, you consider who you're buying from and the causes they support. If you don't, then you're likely supporting companies that are trying to destroy our country and take away our freedoms. Patriot Mobile is America's only Christian conservative wireless provider. They're a cell phone company and a good one. They offer nationwide coverage on the best 4G and 5G networks along with 100% US-based customer support. But here's the deal. Patriot Mobile's mission has nothing to do with cell phones. They carry out their mission by giving back millions of dollars every year to Christian conservative causes that are actively engaged in the fight to save America. Voting is no longer enough to beat the woke. We have to band together, support like-minded companies, and vote with our dollars. That's how we win. Stop supporting companies that want to destroy America and join Patriot Mobile today by visiting patriotmobile.com or call 972-PATRIOT.
Here's a $10 bill. It's got the picture of Alexander Hamilton on the front of it. It's kind of sad. When I was 10 years old, everything that I could buy for $1 now costs about $10. That's the cost of inflation. It's just paper. It's not backed by anything. You can't exchange it for gold and silver. You used to, but you can't do that anymore. And that's unfortunate. Pirates wouldn't accept this. Pirates, they wanted gold and silver. patriots. The founders of this nation also wanted gold and silver coin. In fact, they put a provision in the Constitution, 17 words, that said states could only make gold and silver coins tender within the states. That's why I wrote this new book, Pirate Money, Discovering the Founders' Hidden Plan for Economic Justice and Defeating the Great Reset. It will explain exactly the history of money and exactly why gold and silver coins can be made modern with new technology and a useful monetary system. PirateMoneyBook.com. All right, the Warren Buffett two-step strategy, according to Daniel Jiwani, is find the right business and buy it at the right price. He gave some great foundational truth, but to dig further, you need to read his new book, Take Stock in This. Daniel, why did you write this new book?
Well, the last book, I wrote another book called Outlier Investors, which is not really popular in the market, but I wrote that book for the professional investors. It ended up being read by investors like Bill Ackman, Howard Marks, CIOs of people who run $100 billion funds. And the feedback I got from that book is that it wasn't really for the lay investor out there. So I decided I need to write one more book, and that ended up being Take Stock in This.
You know, that's just amazing. You're in your early 20s or maybe your late teens, and you're writing a book that Bill Ackman and Howard Marks are reading. I mean, that's really pretty cool. You're doing some great things there. All right, so when did this book, Take Stock in This, come out?
Just earlier this year, I believe in January or late last year.
Okay. Simple enough that it could be read by a 16-year-old, but wise enough for seasoned investors. All right, I want you to compare. You've got worldview and mindset shift listed all the way through here, but the first one that you compare, the old worldview, stocks are things you trade to make money. That's the old worldview. What's the new worldview? What should people be doing instead?
I like to look at it from like a real estate perspective. When a lot of people go into real estate investing, one thing that most people know is that flipping real estate is really risky. When you flip real estate, you're trying to buy a property for $100,000 and sell it for $150,000 the next year. That, to most people, is very risky. That's how Dave Ramsey went bankrupt in his early years. By contrast, in a real estate context, investing is investing in the asset for cash flow. It's about saying this property costs $100,000, it'll earn $10,000 in cash flow. That's a 10% return on investment, and hence it's a good investment to make. It's about taking that same approach in the stock market, saying this company costs $10 per share to invest in. It'll earn $1 per share in cash flow. That's a 10% return on investment. Therefore, it's a good investment. It's about avoiding the approach of saying this stock costs $10 to buy. It might go to $20 tomorrow. Let's invest in it. I don't trade stocks and I don't flip stocks. I invest in them.
You know, that's very refreshing. It's what I grew up with and what I really appreciate. You've got another key mindset shift here, though. Number two, it says most stocks go up. That's the old worldview. But number two, it says on the new worldview, it says a handful of stocks drive most of the market's returns. Explain that.
Yeah, sure. So when I started investing, I thought that about 50% of stocks go up, 50% of stocks go down. So if I invest in any particular stock, 50% chance it'll go well, 50% chance it won't go well. But when you take a look at the actual data, what you find is that returns are heavily, heavily skewed. A very small minority of stocks outperform the markets massively and drive all market returns. And the rest of stocks basically underperform the market and do really poorly. I think there's a statistic in the book which says that 10% of stocks or 10% of all market returns came from 4 stocks like over the past 100 years. I think it's like Apple and 3 IBM and 2 other stocks or something. So returns are really, really heavily skewed. And if you want to outperform the market, you need to get in the small minority of stocks that outperform the market and avoid the rest. You need to get in the top 2% of stocks and avoid the bottom 98%. You need to be extra selective / picky about the stocks you invest in.
You know, one of the things I learned investing, and I think you're echoing that, is you find the great company and you let your winners run. You let them go, grow as businesses because you're a business owner. And Apple, I mean, how many people would have traded out of Apple through the years and missed out on huge gains that were to come? By contrast, people like to trade in and out. They like to day trade. They like to, pick entry and exit points and try and time the market. You're talking about buying businesses so you can get cash flows, and I think that's really brilliant. And you're looking for companies that thrive no matter what. I think that's why we see concentrations like the Magnificent Seven and others. Is these are great businesses that have a long runway. Is that what you're feeling?
That's exactly what I'm feeling. I mean, the way to go in the market is to own a concentrated portfolio of stocks that will succeed no matter what. I mean, there was a woman that Charlie Munger knew when he was younger. She owned a soap company. She basically threw all the money she earned from her soap company into three stocks. It was like DuPont, General Electric, and one other one. And she never sold a share. She never bought a share. She just held those three companies for the rest of her life. And it ended up being worth over a $15 million portfolio by the time she passed away. And that's the way to go in the market. If you want to become a multimillionaire, that's the way all the successful investors have done it. Own a concentrated portfolio of stocks, hold it for the rest of your life, and make sure that it's a really good portfolio of stocks.
Yeah, well, you've also got a key point in here that industry matters, that sometimes you might pick the wrong stock in the industry, but if you pick the right industry, you can still be successful. Explain that.
Yeah, sure. So I think that's a good point, and it's a really underrated one by investors. Not many investors talk about the importance of picking the right industry, but it's really important. Not so long ago, I was researching all the credit card companies, and my initial hypothesis was that it doesn't make sense to invest in any of the credit card companies. No one really says Visa is better than MasterCard or MasterCard is better than Visa or Discover is better than XYZ credit card company. None of them really have a huge edge over each other. So I was thinking it doesn't make sense to invest in the credit card industry. But when I looked at the performance of all the credit card companies, what I noticed is that virtually every single credit card company has massively outperformed the market over the past 2 decades. And then I looked at the airline industry, and when I looked at the airline industry, my initial hypothesis was that it perhaps makes sense to invest in Southwest because it's known for having a competitive advantage, or it makes sense to invest in Delta because it has higher profit margins compared to the other airlines. But when I looked at all the airline stock price performance over the past 2 decades, what I noticed is that virtually every single airline has massively underperformed the market. I think the one exception is Southwest, which has just slightly outperformed the market over certain time periods. And what that taught me is that industry matters a lot. If you're in the right industry, you can outperform the market. But if you're in the wrong industry, it's going to be very difficult to outperform.
All right, Daniel, it's fantastic. It's a great book. Take stock in this. Where can people learn more about you and your investment future?
Yeah, sure. On my website, danieljiwani.com, I post a lot of stuff there. My books are available on Amazon. And I'm also on social media, on Instagram, on Twitter, at Daniel_Jiwani.
That's fantastic. Thanks so much for being part of this. Look, we're going to summarize all this in our free economic battle plan. You can get a copy at economicwarroom.com. Remember, what we see as a marketplace, our enemies view as a battle space. This is Kevin Freeman from the Economic War Room.